Section 15.3 deals with adjusting accumulated depreciation. Most businesses use several broad categories of assets in their operations. Cash and other assets expected to be exchanged for cash or consumed within a year are called current assets. They include supplies, prepaid insurance, and accounts receivable, and again, those will be expected to exchange for cash or consumed within a year. Physical assets that will be used for a number of years in the operation of business are called plant assets. Some of them include computers, cash registers, and sales display cases. Businesses may have three major types of plant assets: equipment, buildings, and land. 3 Green records its equipment in two different equipment accounts: office equipment and store equipment. 3 Green rents the building and the land where the business is located. Therefore, the company does not need plant asset accounts for buildings and land. A business buys plant assets to use in earning revenue. For example, 3 Green bought a new lighted display case to draw attention to its products. The display case will be useful only for a limited period of time. After several years, most display cases become worn from use and no longer offer an attractive display. A loss in the usefulness of a plant asset as a result of wear or becoming obsolete is called depreciation. To match revenue with expenses used to earn the revenue, the cost of the plant asset must be expensed over the asset's entire useful life. A portion of the plant asset cost is transferred to an expense account in each fiscal period that the asset is used to earn that revenue. And this is the concept matching expenses with revenue. The portion of the plant's assets cost that is transferred to an expense account in each fiscal period during that asset's useful life is called depreciation expense. 3 factors are considered in calculating the annual amount of depreciation expense for a plant asset: the original cost, salvage value, and useful life. The original cost of a plant asset includes the cost paid to make the asset usable to a business. These costs can include the price of the asset, if there's any delivery charges, and any necessary installation costs. A business removes the plant asset from use when the asset is no longer usable. The asset may be sold to another business or sold for scrap. An estimate of the amount that will be received for the asset at the time of its disposal is called its salvage value. Salvage value is also referred to as scrap value. Since salvage value cannot be known when the asset is bought, it is estimated. The amount an owner expects to receive when the plant asset is removed from its useful use is called its estimated salvage value. The period of time over which an asset contributes to the earning of a business is called its useful life. When a plant asset is bought, the exact length of useful life cannot be known. Therefore, the number of years of useful life must also be an estimate. The total amount of depreciation expense is distributed over the estimated useful life of the plant asset. So you buy a product, maybe like a computer, you figure you're going to have it for 5 years, that would be its useful life, and then you are going to depreciate it, or it's going to become worth less value over the course of those 5 years. 2 factors affect the useful life of a plant asset. Physical depreciation is caused by wear and tear, deteriorating from aging, weathering, and so forth. Functional depreciation occurs when a plant asset becomes inadequate or obsolete. An asset is inadequate when it no longer can perform at an acceptable level of efficiency. A new asset of the same design and capability might replace it. An asset is obsolete when a more modern asset, perhaps using new technology, can operate more efficiently or produce a better service. Next, we're going to calculate depreciation expense and book value. Recording an equal amount of depreciation expense for a plant asset in each year of its useful life is called straight-line method of depreciation. On January 2nd, 3 Green bought a lighted display case for $2,500. The display case has an estimated salvage value of $500 and an estimated useful life of 5 years. Using the straight line method of depreciation, the annual depreciation expense is going to be $400. And it's going to be the same amount for each year that the asset is used. So to figure out this $400, you take your original cost of $2,500 minus the salvage value, how much they think they're going to get out of the product when they sell it, of $500. And so the estimated total depreciation expense is $2,000. It's going to depreciate or go down in value by $2,000. Then you take your estimated total depreciation expense from the previous line, the $2,000, divided by the useful life. We figured we're going to have it for 5 years. It's going to be useful to us for 5 years. And we're going to come up with $400 of depreciation. So our lighted display case that we originally bought for $2,500 is going to go down in value every year by roughly $400. The total amount of depreciation expense that has been recorded since the purchase of a plant asset is called accumulated depreciation. The amount accumulates each year of the plant's useful life. The depreciation expense for the current year is added to the prior year's accumulated depreciation to update accumulated depreciation. For example, the first year, our product is going to be depreciated by $400. In this case, this is the second year. 400 plus 400 would be $800. You add the third year depreciation, since we are doing straight line, it is the same every year, of $400. So after 3 years, the accumulated depreciation for the lighted display case would be $1,200. Next is book value. The original cost of the plant asset minus accumulated depreciation is called the book value of the plant asset. The book value is calculated by subtracting the accumulated depreciation from the original cost of the asset. So you take your original cost of $2,500 minus the depreciation after 3 years of $1,200, and your book value after the third year is your lighted display case is now worth $1,300. Next, we're going to work on Work Together 15-3. Flip your books to page 454, and you will find the problem there. You will also need page 430 of your working papers. Work Together 15-3 says journalizing the adjusting entries for accumulated depreciation. We're going to use the general journal and unadjusted trial balance from our work together in the previous problems and complete these steps. Number 1, calculate depreciation expense for a color printer costing $950. The printer has an estimated salvage value of $150. So again, if we were to sell it after its useful life, we would expect we would get $150 from it, and it has a useful life of 5 years. Going to page 430 again, in your working papers, you should have a sheet that looks like this. So when we take the information there, our original cost is right up here, so that would be our $950. Our salvage value is right there, what we expect to get after we sell it. After we're done with it, $150 will be our estimated total depreciation. So we take $950 minus $150, and so we figure it's going to depreciate $800 over the course of its useful life. Well, what is its useful life? Up here it says it's 5 years. So we're going to take the $800 divided by the 5 years, and we will find out that this color printer is going to depreciate or go down in value by $160 every year. Number 2, we're going to calculate the book value of the color printer at the end of its second year of service. So we're going to take the original cost, $950, that was the original cost of our printer. We're going to depreciate it by $160 the first year. We came up with that number in problem 1. The second year, since it's straight line depreciation, it's going to depreciate by the same value, $160. We add those two numbers together, so after 2 years, it's going to depreciate by $320. To figure out what our book value is right now, we take the $950 minus the $320, and the book value, what our printer is worth after the second year, is $630. When we look at our chart of accounts here, you can see the ones that are squared off there. Those are accumulated depreciation accounts. It's important to retain original cost information for plant assets. If depreciation expense for office equipment were credited directly to the asset account office equipment, that account would no longer show the total amount of the cost of office equipment. The account would be reduced by the amount of the depreciation. Instead, depreciation is recorded into the contra account, accumulated depreciation for office equipment. Each plant asset except for land has a contra account. Land is not depreciated because it rarely loses its value or usefulness. Therefore, land does not have a contra account. If you look at it, our plant assets, they are assets with a debit balance, so the contra accounts accumulated depreciation, office equipment, and your store equipment would therefore have credit balances because they are contra plant assets. We also have some new accounts in our expenses. We have depreciation expense for the different types of equipment that we have. And again, these are used to record how much our equipment or our plant assets are decreasing over the fiscal period. Instruction 3 on December 31st, Southside Electric determined its total depreciation expense. Total depreciation expense is $2,150 for office equipment. And so what they do is they go through all their office equipment and figure out one of those sheets like we did in the first problem, and we figure out how much each piece of office equipment is going to depreciate. They total it up and they make one entry for office equipment. Then they do the same thing with your store equipment. They'll go through all the store equipment, anything that's depreciated, and then they will add that up. And so $7,440 was the amount they came up for store equipment. We are going to journalize the adjusting entry for accumulated depreciation, and we have to do two different entries, one for store equipment and one for office equipment. Okay, so we will go to our journal, which is on page 429. The date is the 31st. The numbers are given to you right here after all the calculations in the background. Depreciation expense is going to be debited for the total amount of your office equipment depreciation expense, $2,150. Accumulated depreciation for office equipment will be credited. Depreciation expense is going up. Accumulated depreciation is going up also. Your second entry will look like the first one, the 31st. You'll have depreciation expense for your store equipment will be debited, meaning that expense is going up for the total amount of depreciation of all your store equipment. Your accumulated depreciation for your store equipment is also going up. Remember, that's a contra asset account, so therefore it has a credit balance and it's going up. Now we have completed section 3 of chapter 15. Your assignment is to complete application problem 15-3 and only instruction 1 of application 15-4. If you look in your textbook, these are found on page 465 and 466. If you look at the bottom of page 465, you will see application 15-3 problem, just what we got done doing. And then when you flip to page 466, instruction 1 is you will post the adjusting entries to the general ledger. So you'll take your general journal entries and you post them to the ledger accounts. When you are done with that, you will submit on Canvas pages 429, 30, 31, 32, and 33, and make sure these get submitted under application 15-3.